Hello investors, it's Zil from Equitymaster bringing you investing insights to make investing simple and easy to learn. To stay updated on investing trends and latest developments on Indian markets, don't forget to subscribe to this channel and like this video. In today's video, I'm going to talk about penny stocks recently bought by foreign investors. Penny stocks often catch the eye of investors looking for high potential returns with minimal initial capital. Though these low-priced stocks can be risky, they sometimes offer significant upside. One way to gauge their potential is by tracking the investment moves of foreign institutional investors or FIIs. FIIs are known for their detailed market analysis and often focus on stocks with strong growth potential. When they increase their stake in a company, it can signal confidence in the stock's future performance. By looking at these trends, investors may gain insights into which stocks FIIs believe hold the most promise for growth in the near future. So keeping that in mind, we will look at 5 such penny stocks where FIIs have increased their stake during the first quarter of the year. Before we move on, please note this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. With that disclaimer out of the way, let's get started. First on our list is Ujjivan Small Finance Bank. The company is a mass market focused bank in India catering to financially unserved and underserved segments and committed to building financial institutions in the country. The share of micro-banking loans continue to form a large share of the loan book at 70%, with 54% of the book being group loans and 16% individual loans. FIIs bet big on the bank in the June 2024 quarter. They increased their stake by a whopping 21.2% to 24.7% from 3.5% in the March 2024 quarter. So what changed for the bank to warrant this kind of investor interest? Achieving significant scale within 7 years, Ujjivan Small Finance Bank is now positioned to compete with established players in the industry. The bank aims to enhance the quality of its loan book by increasing the proportion of secured loans, recognizing that its current mix leans heavily towards unsecured lending at a ratio of 70 to 28. This adjustment is particularly noteworthy given that competitors like Utkarsh Small Finance Bank and Jana Small Finance Bank have a higher share of secured loans in their portfolios. However, the bank's ambitions extend beyond this. It is actively exploring opportunities in gold loans, mutual funds, housing loans, and potential collaborations with fintech firms. In the domain of housing loans, which constitute 15% of the bank's total loan portfolio, a revamped approach is being introduced through a hub-and-spoke model to broaden its customer base. Looking ahead, the bank is gearing up to explore mutual fund offerings further, with plans underway for potential partnerships in this area. The bank is strategizing to expand its presence in metropolitan areas with a focus on mobilizing deposits. Furthermore, the SFB is executing a comprehensive restructuring of its housing loan product to prioritize accessibility and streamline turnaround times. This initiative is crucial in light of the fierce competition from major banks and non-banking finance companies, NBFCs. For FY25, the bank is focusing on 20% growth in its asset book and plans to maintain the return on equity at 20% for the full year. It is also targeting a 35% secured book by the end of the financial year and actively pursuing a universal bank license. Here's how the stock price has performed in the past 1 year. Moving on to the second stock. Vodafone Idea is one of the leading telecom service providers in India. It is engaged in the business of mobility and long-distance services, trading of handsets and data cards. The company's business services include voice services, broadband services, content services, enterprise services, and other VAS offerings like entertainment, SMS, utility, etc. Currently, the company has a subscriber base of 223 million across India with a telecom market share of 18.7%, making it the third largest telecom company. During the June 2024 quarter, the company saw heavy institutional investor interest. FIIs picked up a 10.7% stake in the company, taking the total shareholding to 12.67%. This is a huge sign of confidence in the company's growth prospects. Vodafone India has announced several strategies and plans in place to secure its future growth. One of its primary focuses is on expanding its 4G coverage and launching 5G services across India. The company plans to invest between Rs 500 billion and Rs 550 billion over the next 3 years to support this expansion. This significant capital expenditure will help VIL enhance its network infrastructure and improve service quality. In addition to its network expansion, Vodafone Idea is focusing on strategic partnerships and digital revenue streams. The recent fundraise of Rs 240 billion, including contributions from partners like Nokia and Ericsson, strengthens the company's ability to execute these initiatives. With these funds, VIL aims to secure more spectrum and improve its technological capabilities. However, industry experts have raised concerns about Vodafone Idea's long-term viability, suggesting that the company's recent capital raise, although a step in the right direction, may not be sufficient to halt its ongoing market share erosion. Vodafone Idea's capital expenditure, CapEx, is expected to be significantly lower than that of its competitors, who are forecasted to spend at least 50% more. This disparity in spending could directly impact Vodafone Idea's ability to maintain its current market position. Additionally, Vodafone Idea faces substantial adjusted gross revenue (AGR) and spectrum-related payments starting in FY26. These financial obligations add significant strain to the company's already stretched balance sheet. Although the government has the option to convert some of these dues into equity, this move alone may not be enough to relieve the pressure. Industry experts believe that for Vodafone Idea to achieve free cash flow neutrality, its average revenue per user (ARPU) would need to increase significantly from December 2023 levels. This scenario, however, is seen as highly unlikely in the medium term given the competitive nature of the telecom market and the pricing pressures that exist. Here's how the stock has moved over the past 1 year. Third on our list is NHPC, India's leading hydroelectric generation firm. The company supplies substantial power to utilities across eastern, northern and northeastern regions through long-term power purchase agreements (PPAs). It boasts a total capacity of 7,000 megawatt, filling the gap during peak demand periods when solar power falls short. Coming to foreign investment, FIIs added 2.16% of the company's share during the quarter. FII shareholding stood at 8.96%, up from 6.8% in the March 2024 quarter. This could be on account of the company shifting its focus towards the solar energy segment. Out of 10,499 megawatt capacity under construction, the company has allocated 1,135 megawatt for solar power. It has recently signed a contract to develop additional 2,000 megawatt solar power capacity in Rajasthan. Apart from that, about 9,090 megawatt solar power capacity is under tender and pipeline, including as an intermediary procurer. The company has also won other government projects. Recently, it announced a joint venture agreement between NHPC and Andhra Pradesh Power Generation Corporation. The JV is for implementation of pumped storage hydropower projects and renewable energy projects in Andhra Pradesh. In the past 5 years, the company has reported poor revenue and net profit growth. It also has low return ratios. Moreover, the expansion plans of NHPC exposes the company to the project execution and funding related risks. This is, however, mitigated largely through the company's favorable capital structure, consistent cash flows from operations with adequate cash and bank balance, and extensive experience in implementation of various projects in the past. Looking ahead, the company has outlined a massive capex outlay for doubling the installed 7,000 megawatt capacity by financial year 2027. It has guided for a capex of Rs 90 to 100 billion for the next 10 years. Here's how shares of NHPC has moved over the past 1 year. Fourth on our list is Dhani Services. The company is primarily engaged in providing technology-enabled subscription-based healthcare and transaction finance services through its Dhani app. It is also engaged in diverse business activities, including asset reconstruction, stock broking, etc. Dhani Services was founded by Sameer Gehlot in 1995 as Indiabulls Ventures Limited, which was later renamed Dhani Services Limited in October 2020 to accommodate the consumer business of the Indiabulls Group under one brand name. The company was largely a retail securities broker. However, it now straddles diverse and multiple business segments, including consumer financing, stockbroking, ARC, e-commerce, and real estate. FIIs bought 1.97% of the company's share in the June 2024 quarter. FII shareholding increased from 14.63% in the March 2024 quarter to 16.6%. This could be on account of better growth prospects. The company has recently ventured into real estate. It has picked up a land parcel in Gurgaon and Mumbai measuring 17 acres and 0.57 acres respectively. This will be the launchpad for its real estate development business, and it will continue to explore deals in the marquee micro markets in Mumbai and Gurgaon. In the financial services space, the company has made sizable investments in developing advanced data analytics capabilities to manage large customer data and help create customized offers product for the customer for their respective needs. However, note that the company has not been profitable in the last 3 years. This has resulted in weak return ratios for the company. Promoter holding also stands at a low 29.1%. The financials are expected to turn around, but how that pans out remains to be seen. Investors can find more forward-looking statements at the company's annual general meeting, which is expected to be held on 25th September 2024. Here's how the stock has performed in the past 1 year. Last on our list is Suzlon, one of the leading global renewable energy solutions providers. If you remember, I spoke about Suzlon in my previous video and extensively discussed the company's growth strategies and targets for the financial year 2025. If you haven't checked the video yet, I highly recommend you do so. The company has seen a complete turnaround in the past 1 year. Suzlon Energy share price has transformed from a laggard to a leader, delivering multi-bagger returns of over 200% in the past year. In 2024, it has continued this upward trajectory, with the stock surging over 100% so far. FIIs have also put their might behind it. They increased their stake to 20.6% in the June 2024 quarter from 18.67% in the March 2024 quarter. This has been for good reason. Going forward, Suzlon is planning to focus on hybrid projects that combine wind energy with other renewable sources and storage solutions. So there you go. These were just some of the penny stocks that foreign investors bought recently. Tracking the investment patterns of foreign institutional investors can provide valuable insights for retail investors, especially when it comes to penny stocks. While these stocks can be volatile and risky, FII activity often highlights companies with strong potential for future growth. The 5 penny stocks discussed today have attracted increased interest from FIIs in Q1, suggesting that they see promising opportunities in these companies. However, it's important to note that blindly following institutional investors has risks. FIIs have access to research and strategies that may not align with the goals or risk tolerance of individual investors. Additionally, they often have longer investment horizons and higher risk tolerance, which may not be suitable for everyone. While FII investment is a positive signal, it's crucial to conduct your own research, assess the risks, and ensure any decision aligns with your overall strategy. Diversification remains key in managing risk in this high-reward sector. That's it for today. Don't forget to like this video and share it with your friends and family. Have a profitable day and happy investing.